Welcome to the XFO Intelligence Podcast channel. Today, we dive deep into a transformative and urgent topic, architecting the multiplanetary economy, a new paradigm for deep tech capital allocation. Why do traditional venture capital models fail in space? And how can a physics-aware framework generate true asymmetric alpha in this final frontier? Humanity is standing at the precipice of its greatest technological leap, the transition to a multiplanetary species. The space economy is rapidly evolving from government-led initiatives into a booming commercial sector. But there's a critical flaw. Investees are forcing the realities of orbital mechanics and heavy manufacturing into a software-defined financial mold. They apply SaaS-era metrics to aerospace, mispricing risk, starving innovation in the valley of death, and destroying capital. To create true asymmetric alpha, we need to abandon legacy financial heuristics. Instead, we must adopt a specialized physics-aware investment system, one that respects thermodynamics, manufacturing challenges, and the long-term timelines of building civilization-scale infrastructure off Earth. Let's break down the key components of this revolutionary approach. First, we have the teleological anchor, redefining the investor's identity. Traditional venture funds focus on short exits, tied to market noise and 5 to 7 year cycles. In multiplanetary investment, the horizon must extend 10 to 20 years. Investors need to become stewards of civilization, seeing capital as the energy that overcomes Earth's gravity well. This mindset is essential to weather the inevitable test failures and macro liquidity shocks, without panic selling, without losing confidence. We then approach this mandate using a strict Barbell Portfolio Architecture. 70% of capital goes to foundational picks and shovels, infrastructure, materials, ground stations, proven launch components with predictable scaling. The other 30% is reserved for extreme moonshots, high-risk, civilization-scale projects like nuclear thermal propulsion, in-space manufacturing, and orbital debris removal. These bring massive upside potential. Next, we apply the physics-aware filter to every investment. We ask, does this company break down problems into raw physics costs? Do they have a credible plan for mass production? Without a clear manufacturing path, it's a science project, no investment. We reassess risk based on empirical data. In aerospace, a well-instrumented failure that yields critical telemetry is success. We look ahead. When a new technology succeeds, what bottleneck appears next? The real alpha comes from funding solutions to that next bottleneck, before anyone else sees it coming. We mitigate fatal risks in advance. Regulatory capture, supply chain failure, ITAR violations. If these can't be managed, we walk away. What replaces SaaS metrics? We need a 4-dimensional dashboard of physics-based and operational indicators. We track engineering velocity. Are they moving from bespoke cleanroom work to automated assembly? Unit economics, fixed-price contracts, reducing cost per kilogram to orbit, and funded backlogs with 40% or more projected gross margins. Regulatory friction. Companies that de-risk regulation and maintain domestic supply chains hold a significant moat. And finally, ecosystem indicators. Mass deployed, successful propulsion demos, orbital debris mitigation. Companies need to score on at least 3 of these 4 dimensions. In deep tech, crises are inevitable. Smart investors rely on scenario playbooks. If capital dries up, we execute the zombie quarantine. No more capital to companies without near-term milestones. Bridge financing goes only to those with imminent breakthroughs. If a company hits a regulatory wall, capital shifts to aligning with agencies. And at key inflection points, we enforce talent arbitrage. When scaling, we bring in high-volume manufacturing veterans and shift technical founders from chief engineer to chief visionary. Over time, systemic insights emerge. Elite allocators direct capital to bottlenecks before they peak. Supply chain diversity isn't just a hedge, it's an immune system for the entire network. And creating regulatory symbiosis yields durable competitive moats. It attracts institutional capital and leaves move fast and break things competitors grounded. Ultimately, building a multiplanetary economy demands rigorous capital allocation, rooted in existential purpose, physics-based measurements, and scenario-driven execution. This isn't speculative gambling. It's a repeatable, calculable engine for asymmetric financial returns, while also architecting the future of human civilization. Thank you for listening to the XFO Intelligence Podcast. If you found this episode insightful, please like, share, and subscribe. We'd love to hear your feedback. Email us anytime at xfointelligence@gmail.com. And if you'd like more information about our new Thought Leadership on Demand service, drop us a line. Disclaimer: the content provided in this podcast is for informational purposes only and does not constitute financial or investment advice. Always conduct your own diligence before making investment decisions.